Behind the scenes of bankruptcy. Top 5 reasons for bank failure. Bankruptcy is a frightening reality for many people and businesses, but it doesn't always come out of nowhere. Understanding the underlying causes of bank failure can help us avoid them in the future. In this video, we'll be taking a closer look at the top 5 reasons banks go bankrupt. By understanding what happens behind the scenes, we can take steps to ensure our financial security. So let's dive in and explore the 5 primary causes of bank failure. 1. Lack of diversification. One of the top reasons for bank failure is the lack of diversification in their business. A bank that relies too heavily on a single product, service, or market is at risk of experiencing financial turmoil if there are any changes in the market or regulatory environment. For instance, if a bank solely focuses on commercial real estate loans and the market experiences a sudden downturn, the bank's profits will take a hit, and it may be unable to recover its losses. Furthermore, if a bank relies too heavily on a single borrower or group of borrowers, it can be disastrous. Banks are typically highly leveraged, meaning that they hold only a small portion of their assets in cash reserves. As a result, if a single borrower defaults on a large loan, it can trigger a domino effect, resulting in the bank's inability to meet its financial obligations. To mitigate these risks, banks must diversify their revenue streams by offering a wide range of products and services and expanding into new markets. This not only reduces the risk of a sudden loss of income, but also increases the likelihood of success by appealing to a broader range of customers. In summary, banks must focus on diversification to minimize risks and increase their chances of success. While diversification comes with its challenges, the benefits far outweigh the risks of a lack of diversification. As the saying goes, don't put all your eggs in one basket. 2. Poor risk management. One of the top reasons for bank failure is poor risk management. Banks take on risks every day, whether it's making loans to borrowers or investing in assets like stocks and bonds. But if a bank doesn't properly manage these risks, it can spell disaster for its bottom line. Poor risk management can come in many forms. One common example is when a bank becomes overexposed to a particular industry or geographic region. If a bank has too many loans in the oil and gas sector, for instance, it could suffer if that sector experiences a downturn. Another example is when a bank fails to properly assess the creditworthiness of its borrowers. Banks use credit scores, income statements, and other information to determine whether a borrower is likely to pay back their loan. But if a bank makes too many loans to risky borrowers who ultimately default, it can suffer significant losses. Finally, poor risk management can also come from a lack of oversight at the senior management level. If the bank's executives don't have a clear understanding of the risks the bank is taking on, they may not take steps to mitigate those risks. Overall, poor risk management is a significant factor in a bank's failure. Banks need to have strong risk management policies in place and ensure that their executives are overseeing the bank's activities in a way that minimizes risks and maximizes returns. 3. Heavy leverage. Another common reason why banks fail is heavy leverage. In simple terms, leverage refers to the use of borrowed funds to increase the potential returns of an investment. Banks typically borrow money from their depositors and other financial institutions to invest in various assets such as mortgages, corporate bonds, and government securities. While leveraging can increase the potential returns, it can also increase the risks. When the value of the assets falls, the bank may not be able to repay its debt, leading to bankruptcy. Furthermore, if a bank's assets are largely concentrated in a particular sector or asset class, the risks become even greater. One example of the consequences of heavy leverage is the financial crisis of 2008. Banks in the United States had heavily invested in mortgage-backed securities, which turned out to be riskier than they had anticipated. As the value of these assets declined, the banks faced significant losses and struggled to repay their debts. To mitigate the risks of heavy leverage, banks need to have adequate capital and diversify their investments. They also need to carefully manage their borrowing and lending practices to ensure that they have enough liquidity to meet their obligations in case of market volatility. In summary, heavy leverage is a major factor in bank failures, and can have serious consequences for both the bank and its customers. Banks must be cautious when using leverage and implement sound risk management practices to prevent future failures. 4. Inadequate liquidity. Liquidity refers to a bank's ability to meet its financial obligations as they come due. In simpler terms, it's the bank's ability to access enough cash or assets that can quickly be converted into cash to meet the demands of its customers. When a bank doesn't have adequate liquidity, it may have to resort to desperate measures, such as selling assets or seeking emergency funding from the government. This situation can put the bank's financial health and reputation at risk. One reason a bank may have inadequate liquidity is poor asset quality. If a bank's assets, such as loans, are performing poorly or not generating the expected revenue, the bank may not have enough cash to cover its obligations. Another factor that can contribute to inadequate liquidity is excessive reliance on short-term funding sources, such as deposits. When these deposits are withdrawn unexpectedly, the bank may not have enough cash to meet its obligations, which can lead to a run on the bank. Lastly, inadequate liquidity can result from poor cash management practices, such as misjudging the timing of cash inflows and outflows or not keeping enough cash reserves on hand. Overall, inadequate liquidity is a significant risk factor for bank failure, and it's crucial for banks to maintain a strong liquidity position to ensure they can meet their obligations and maintain customer trust. 5. Regulatory changes. Another reason why banks fail is regulatory changes. These changes can come in the form of new legislation, tighter rules, or even stricter requirements for compliance. These regulations can be challenging for banks to keep up with and adhere to, especially for smaller institutions. The compliance cost of new regulations can be a huge burden on the bottom line of smaller banks and can often be difficult to manage. The global financial crisis of 2008, for example, prompted a series of regulatory changes across the banking industry. This crisis highlighted the need for stricter regulations to protect consumers and prevent the same thing from happening again. However, these regulations came with additional compliance costs and operational challenges. In addition to being costly, regulatory changes can also impact the way banks conduct business. For instance, a new regulation that mandates tighter lending standards can limit a bank's ability to make loans, resulting in decreased revenue. As a result, some banks might have to take on riskier assets to maintain profitability, which could lead to greater risk exposure. In summary, regulatory changes can have a profound impact on the banking industry and are a major reason why banks fail. It is essential for banks to remain aware of regulatory changes and adapt their operations to comply with these changes, while also maintaining profitability and reducing risk. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.